Landlords are being forced to cut the rent, with data from Apartment List showing that 57 of the 100 largest cities in America now have declining rents, with these rent declines especially severe in cities like Las Vegas, where some landlords have had to cut their rent by as much as 25%, which is great news for renters out there, but it's potentially even better news for home buyers, because the history of the US housing market says that when rents go down, home prices go down. And the mechanism that's going to cause the prices to go down is landlords selling, because right now lots of them are losing money with their cost of debt, the orange line, which is roughly equivalent to the 30-year fixed mortgage rate, hitting 7% in June. Now that cost of debt, it's way higher than the cap rate or the rental profit for these landlords, which means that over the last 15 months, any landlord pretty much who's bought into the US housing market with debt is losing money on their rental. Now, lots of landlords didn't mind losing money initially on their rental because they thought that rents would continue to go up, but now many of them are realizing they were wrong about that, particularly in a city like Austin, where Progress Residential, one of the biggest Wall Street landlords in America, has this rental on the market for $2,500 a month. Now that's roughly equivalent to what it was listed at 2 years ago in June 2021, meaning no rent growth in Austin over the last 2 years. However, Progress Residential's expenses have gone way up during that same time period, with their property taxes in particular increasing by over 50%, from $6,000 a year to $9,300 a year, which mixed with an increasing cost of debt makes it very likely that Progress Residential is now losing money on that rental in Austin that they purchased 2 years ago. Now, are they going to sell? I don't know. But here's what I do know. According to the US Census Bureau, there's 17 million single-family rental homes in America. In addition, there's roughly 6 million duplex and triplex rentals, meaning in total that roughly half the rental inventory in America is single-family duplex and triplex, much of which is owned by small mom-and-pop landlords. Now, these small mom-and-pop landlords don't have the same access to capital that a big Wall Street investor like Progress Residential does, so they are likely struggling behind the scenes right now. That's what these declining rents are showing you, everyone, that yes, it's good news for renters who are struggling with affordability, but the real story here is the pressure it's going to exert on landlords to liquidate their properties over the next year, particularly the ones who purchased in the last 2 years at a high price, at a higher cost of debt. And what are some cities where we could see this landlord sell-off happen first? Well, let's look at some data from Realtor.com on the areas where rent has dropped the most. Their data is showing that Austin, Round Rock, Texas has experienced the biggest rent decline at -6% year over year, with Las Vegas, Phoenix, and Riverside, California also experiencing 6% rent declines. In addition, they show that rents are down in Charlotte, Dallas, Sacramento, San Francisco, and Tampa by 4%. And the reason that rents are starting to drop in these cities is because the landlords are just facing lots and lots of vacant apartments. They cannot find people to rent the apartments in 2023 in the same way they could 2 years ago for a couple different reasons. Number one, the rent just went up way too much during the pandemic, so even with these initial declines, it's still very expensive. Number two, there was lots of evictions that were unleashed onto the rental market over the last year, which increased vacancy. And then number three, apartment developers are building a ton of new apartments right now, over 1 million apartments in the construction backlog, which are being added each month to the housing stock in America, which is causing the vacancy rate to go up. And one city in particular where we're just seeing the vacancy rate skyrocket for rentals is Las Vegas, where data from Apartment List shows that the vacancy rate has now surged up to 8.7% for apartments. For comparison, the peak of the pandemic in August 2021, it was only 2.5%. So the number of vacant apartments has more than tripled in only 18 months in Las Vegas. It's a similar story in a market like Nashville, where the vacancy rate more than doubled from 4.1% to 8.7%. So also a metro like Dallas, where the vacancy rate is now up to 8.5%. And ultimately, these higher vacancy rates and the declining rents resulting from these vacancy rates is something that's going to push home prices down over the long term. And it doesn't even need to really cause a wave of landlords selling to do that, because ultimately, in the long-term history of the US housing market, rent growth and home price growth is very correlated. They're two sides of the same coin. And in fact, right now, we're in a situation where home prices have grown way more than rents over the last year or two, with the home price to rent ratio in America being around 15x 15x in the middle of 2023, taking the typical home price of $340 and dividing it by the annual apartment rent of $22,000. Now 15x, that's down from where it was a year ago, but it's still way above the long-term average home price to rent ratio of 11x, meaning that this is saying home prices are around 25% overvalued right now in comparison to rents. But ultimately, that situation is not going to sustain itself. Either home prices come down to the level of rents, or rents go up to the level of home prices. And since rents are going down right now, it doesn't look likely that they're going to go up to the level of home prices, which makes declining home prices the most likely outcome to bring equilibrium back to the US rental market. Because if you think about what the average first-time home buyer in America is thinking right now, they're comparing their cost of rent to their cost of buying a house, and the cost of buying a house is way more expensive right now, particularly in a metro like Dallas, where the cost to buy in terms of mortgage and property taxes is $2,700 a month right now compared to $1,800 a month to rent an apartment, meaning it's $900 a month more expensive to buy in Dallas, when historically the cost to buy and the cost to rent were roughly equivalent over the last decade. Same thing in a metro like Seattle, where the cost to buy is around $4,400 a month for the typical house in terms of your mortgage and taxes, compared to $2,200 a month for your cost to rent an apartment. Now, buying is typically more expensive than renting in Seattle, but normally it's only around $700 more expensive over the last decade. Today it's $2,200 a month more expensive. So that's a huge incentive for renters to stay renting, which is ultimately one reason why home buyer demand in the US housing market is so low today. Mortgage applications to buy a house, they're at the lowest level in 15 years. Existing home sales, they're at the lowest level in 15 years. Why? Because it doesn't make financial sense for home buyers to purchase houses in today's market with prices and mortgage rates so high. And so these buyers are going to stay on the sidelines until the prices and the mortgage payments go down closer to the level dictated by rent and the market finds equilibrium. But it's not just going to be lower demand that lowers home prices, it's also going to be increased supply, because many of these landlords will sell, especially in a state like Florida, which is an area where we are now seeing a deluge of vacant rental inventory flood the market, particularly vacant houses in Florida. It's not just apartments, it's also houses. We're in a city like Palm Beach County, north of Miami. We can see there's been a 160% increase in the amount of vacant houses for rent over the last year. Similar situation in Broward County and Miami-Dade County. There's anywhere from 2 to 3 times more vacant rentals on the market today compared to 1 year ago. Now, interestingly, Florida is a housing market where the rents have just kind of started to go down a little bit. They haven't really become significantly more affordable yet in Florida, but they will, because when you go on Zillow and look at just how many vacant rentals are out there, it's going to shock you. Like when we zoom in here on West Palm Beach, particularly, certain areas to the west of West Palm Beach, look at all of these houses and townhomes in particular. In this one neighborhood on its own, there are hundreds of houses available for rent right now. And we are now seeing some of these houses cut the rent, like this 3-bed, 2-bath. They've cut the rent from $5,500 a month in January to $3,000 a month today in June. And $3,000 a month in rent, that's still expensive. And that's just one house and one property. But when you look at the aggregate inventory data, you see how many more houses are vacant for rent today. I feel pretty confident in projecting that the trend is going to continue to be downward in terms of these rents in an area like Florida, as well as a state like Texas. Texas is the other area where the number of vacant rentals is just exploding, particularly in Austin and Dallas and Houston. Lots of landlords bought houses during the pandemic to rent out, and now we're seeing those houses listed on the market for rent, and there's not a ton of takers, with vacant rental inventory up 175% in Fort Bend County in Houston, 151% in Travis County in Austin, and 131% in Denton County in Dallas. Now, one important thing to understand is that not all areas of America are now experiencing declining rent. It's mainly the areas in the southwest part of the country as well as the southeast which are seeing a softening rental market, where in comparison, the Midwest and the Northeast is performing better in terms of rent growth. The same data from Realtor.com showing that the highest rent growth is in cities like Columbus, Cincinnati, St. Louis, Indianapolis, Louisville, New York, Milwaukee, Detroit, Oklahoma City, and Richmond, Virginia, which is something that I predicted about a year and a half ago on this channel that the so-called boring, cheaper Midwest markets would do better during the housing downturn than the hot Sunbelt markets. And that's something we're really starting to see come to fruition in terms of rent, in terms of home price growth. And in fact, this decline in rents and the downturn in the rental market is something I did predict 15 months ago on this channel. And I did that when everyone else was saying rents would continue to go up, because the argument was at the time that mortgage rates going up was going to cause a greater demand for rentals, which intuitively makes sense. However, that's not happening, which is so interesting, everyone. The fact that mortgage rates are 7% and mortgage applications to buy a house are at their lowest level in 15 years, yet rental demand is still going down. That's amazing when you think about it, and it highlights how the housing market has now entered a deflationary type of situation in a deflationary episode. And I believe that deflationary situation is going to continue over the next 2 years because the amount of homes and apartments under construction right now is absolutely amazing. Data from the US Census Bureau is showing that there's over 1.1 million apartments and condo units currently under construction or permitted. That's close to a record high back to 1973. Additionally, the number of single-family homes in construction and permitting is 840,000. That's down a bit from where it was a year ago, but still a pretty high level historically, which means that we are just going to see in the second half of 2023 and 2024 lots of newly developed homes and apartments hit the market, which is going to further increase the vacancy rate and put downward pressure on rents and home prices. This is great news for you as a prospective home buyer out there. More inventory is on the way. However, I know a lot of you are sick and tired of waiting. I see you guys here in the comments section on YouTube, and some of you say that you've been waiting 2 to 3 years to buy a house, and you're starting to believe prices will never go down and the inventory will never go up. And that's understandable to think that way if you've been waiting a really long time to buy a house. However, I'm here to tell you folks, the fundamentals of the housing market in the background are all pointing to lower home prices and a further housing crash and home price correction coming. To unlock those declines, we are going to have to see inventory on the US housing market increase. Right now, the inventory levels for sale are still at a very historically low level, with Realtor.com reporting that there's 614,000 active listings in June 2023. That's roughly 45% below the pre-pandemic norm. So this for sale inventory has got to come up by more before we see prices go down meaningfully. Because the thing to understand, there's nothing stable about these very low inventory levels. They were created by artificial government manipulation of the housing market through extended foreclosure moratoriums, by pumping $5 trillion into the economy, making everyone feel wealthier and richer. These are things that reduced inventory temporarily. However, that reduced inventory is not going to last. Right now, in a metro like Boston, there's 4,300 homes on the market for sale, which represents only 0.4% of all of the houses that are owned. Now, 0.4%, that's low. If you go back 4 or 5 years ago, it was 1%. This was a higher inventory environment in Boston where 1% of the homes were on the market. And that actually makes you realize that there's not a whole lot of distressed selling that is needed to improve inventory levels. If only 1 out of 200 investors and homeowners in an area like Boston experiences distress, that's something that could double inventory. If we go to a metro like Miami, we can see Miami has a higher inventory level. 1.5% of the houses are currently on the market for sale. But again, that's less than it was historically, when it's usually around 3% of houses for sale in Miami before the pandemic. But again, what this means, folks, is that all we need is about 0.5% or 1% of the homeowners or investors and landlords or Airbnb owners in Miami to experience some type of distress to all of a sudden return inventory to normal levels and push prices down further. You have to ask yourself, everyone, do you think we could see 0.5% of the homeowners in America experience some type of distress, or maybe 2 to 3% of the investors in America experience distress due to declining rents? Is that feasible? Of course it's feasible. And as the recession gets worse and there's more liquidity needs and forced selling, I think a lot of you are going to be shocked at how quickly for sale inventory rises in your housing market. So be very, very careful if you're buying today, particularly if you're someone who's starting to think that the downturn won't happen or isn't going to happen. The fundamentals are still pointing in that direction. We are in the biggest housing bubble of all time. The relationship of home prices to rent, home prices to income, and home prices to inflation. Short of some miraculous event where the economy just booms in a way that no one's expecting, those prices are going to need to come down to the levels of rent and income and inflation. Lastly, before signing off, I want to show you guys some maybe picks I have as markets that could be good places to buy for investors right now, entering the second half of 2023, even in this environment of declining rent and higher property taxes, where as an investor could you buy where it makes sense, where you could actually cash flow from day one on your property? Well, you can use Reventure app to do this. And the first thing I would do is to go and look at the cap rate in all the different housing markets in America. Because higher cap rate markets right now, I think will do better going forward. But in particular, I would want to filter higher cap rate markets, say at least 6%, mixed with low property tax rate markets. The annual property tax rate is less than 1%. All of a sudden now you have a list of more investor-friendly housing markets. In addition, you might want to add a constraint on how overvalued the housing market is. Maybe say no more than 25% overvalued, so I protect my principal. All of a sudden, you now have this curated list of housing markets with higher cap rates and lower property tax rates and less overvaluation, which could be better places to buy. I'm not guaranteeing that, but it's probably a good starting point if you're an investor who's looking for new markets to purchase. You can access that data, whether you're an investor or a home buyer, for free on Reventure app for a limited time. Go to www.reventure.app and create an account.